Right. So in today's section, I'm going to solve a question on cash flow, preparation of cash flow statement. So I believe you've gone through the theory using the previous videos about the preparation of cash flow statement. Why we prepare cash flow statements? Is there any reason behind that? Yes, to just reconcile the difference between profits and cash. So let's take this particular question and then we look at it into detail. So picking the material, question number 7, Elmgrove Limited. Let's go straight to the comments. Required. Using the information provided, prepare a statement of cash flows for Elmgrove for the year ended 31st December 2014. Using indirect method, 20 solid marks. B, write a memorandum to a director of Elmgrove summarizing the major benefits a user received from a published statement of cash flow. We are just asking for the benefits. The benefits of cash flow statement. You just spell out the cash position. To spell out the cash flow position, and then also to reconcile the difference between cash and profits. Good. So basically, that is the reason. Now let's go straight to the footnotes. As usual, this one will be rough. Requirement, additional information, and financial statement. They say the following notes are also relevant. Okay, so the notes start from the top. Let's go to the top. There will be some 1 or 2 lines be there. As a financial accountant of Elmgrove, you are responsible for the preparation of statements of cash flows for the year ended 1st December 2014. Let's go to the footnote together. The following notes are also relevant. Note 1. Property, plant, and equipment, but it's been repeated. Property, plant, and equipment held by Elmgrove are items of plant and equipment and freehold premises. During 2014, item of plant and equipment, which originally cost 40 million, were disposed of, resulting in a loss of 6 million. This item have a net book value of 28 million at the date of disposal. Powerful. Over here, this is disposal. In disposal, you need 3 items. All of them are equally important. The 3 items, anytime they dispose assets in cash flow, look out for 1. First thing, the proceeds. so much. Second, the carrying amount. Third examiner, less carrying amount. Third, the profit or loss of disposal. You need all these three items. However, we must always give you two so that you look for the other one for us. So here they give us carrying amount, they give us loss. They didn't give us the proceeds. You must find the proceeds. You know, everything have a different place where we record them. This goes to investment activity. Proceeds from the sale goes to investment activity. The carried amount also goes to PPE, acquisition of PPE, also invested. The profit or loss also goes to operating activity. So you need all of this operating activities. You need these three items so that you can complete the cash flow fully. So you just have to make the other one the subjects and then we move on. So make the unknown the subjects. Okay, so let's go to note. Note 2, short-term investment. They say the short-term investment meets the definition of cash equivalent per IAS 7 statement of cash flow, meaning that if you are looking for the cash and cash equivalent, kindly add a short-term investment. Go to the financial position, check the current asset, you see a short-term investment there. Good, short-term investment. It means that this short-term investment should form part of what? The cash and cash equivalent. That's all. Let's go to the next footnote. Note number 3, current liabilities. The current liabilities consist of the following. Bank overdrafts. Bank overdraft should form part of cash and cash equivalent. Trade payable will go to changes in working capital. Interest payable, where will it go? Use that one to calculate the interest paid. Income tax payable, tax paid in that order. Note 4, 10% debenture. On 1st May 2014, 50 million of 10% debenture was converted into 50 million ordinary shares. So now wait, go to the debenture and go to equity shares. Let's do something there. They converted debenture into equity shares. That's powerful. Check the non-current liability, check the debenture. The difference is what? 50. Because as of 2013, it is what? 150. And then they reduce it, they converted 50. So now left with what? 100. Powerful. Then go to stated capital, the share capital. The share capital as we start is 120. But here the difference is what? The difference is 110. Meanwhile, they've converted 50. So out of the difference of 110, not all of them came in as a result of cash. 50 was a mere conversion, no cash. So out of 110, you subtract 50 from it, left it was 60. So issue of shares for cash will be what? 60. Powerful one.
Okay.
Then we are done with 10% debenture. Note 5, depreciation. Depreciation charge for the year included in statement of profit and loss is 43 million. That's all. Now let's go to the financial statement. Scan through to determine unusual item. Okay, so let's see. Property, plant, and equipment, 327,000 and then 264. So we check current assets. All of them are there. Equity, capital surplus, income surplus, everything is there. Now the capital surplus, check carefully. The difference, it was 97. Now it has reduced to what? 66. 97 reducing to 66. What will happen before capital surplus will decrease? Is there a revaluation loss which has been reversed? So they've had a revaluation loss and they've used the revaluation loss to reverse a previous gain, which resulted in this. Okay, let's see. Non-current liabilities, the bench, we've talked about it. Current liabilities, they're giving us a breakdown. And let's go to the profit and loss. Please, the profit and loss we need for only the current year, 2014. If they should have given us, let's say, 2 years, kindly pick the current year. Don't touch anything coming from the previous year when it comes to the profit or loss. Now check through. First items that you have to check is your profit before tax, whether it's intact, it has been given to you. Clearly, we can find profit before tax. Second, check for your finance cost. Yes, clearly we can find finance cost here. Again, check any other item which has been added. You take it off. Any other item like depreciation, finance income, I will reverse it. Admin, I will leave it. Distribution, I'll leave it. I'll not reverse it. The income tax. Then dividend paid. During the period, it will go to where? Investing. Good one. And that's all. You are going to start the work. So let's have this under exam condition. And let's balance it off. Okay, so solution. Okay, so let's kickstart the game. So now solution. First of all, the name of the company, Elmgrove. So let me divide the board into two. Let me start from this side and come and end here. I'm starting here and come to end here. So first, maybe to your question number 3, boldly on top. Is it coming? Question 3? No. So question 3 on top. Yeah, the name of the company. The name of the company. And statement of what? Of cash flows for the year ended. Um, 31 December 2014. Don't forget your reporting currency. 2. Cash flow, you need to report in currency. Check whether they are in thousands or they are not in thousands. So basically, this particular question, let me see if they're in thousands.
So we are solving question 7. Oh,
Yes, please.
by phrasing question 3.
Good. So in exam, it will be your question number 3.
Okay.
On the day, when I give you the question paper, on top of it, it will be question 3. Now, every year, there must be a preparation of financial statement. We are going to prepare financial statements. And out of it, they are basically A, B, C, and then D. P&L, changes in equity and financial position. That's one set, 20 marks. Another set, cash flow on its own. So this is your question number 3, 20 marks. So definitely there should be one of this, or the two will not be there at the same time. And it's your question 3. So when this set comes, cash flow, where dodge. Where cash flow also comes, this one to where dodge, in that order. Okay, so that is it. Now let's see something in here. Your 2 reporting currencies. Here is in millions. So Ghana cedis in millions. Ghana cedis in millions. Translate like this. Okay, then what do you do again? We now start from cash flow from operating activities. Right here, operating activities. OA. First thing is you write your profit before tax. So locate your profit before tax. Profit before tax. So I'll go to the question and look for profit before tax. So join hands, let's look for this item. From the P&L, profit before tax is here, 109. So that is 109. So I write it here, 109. Immediately, don't rest. Add the finance cost to it. So add back interest expense or the finance cost. Locate the finance cost from the P&L. Now the finance cost from the P&L happen to be 17.
Yeah, 17.
So add back the finance cost. When you add back
126.
126. We can call it profit before interest and tax. This one give us profit before interest and tax. That is a profit, 126. Then we must adjust this profit. So third examiner, Mr. Examiner, this profit, we are going to massage it. We said profit is not equal to cash. The reasons could be non-cash item, capital expenditure, alien item, transfers. So you must adjust this. So third examiner, that adjustment for that is first thing. Don't forget, it's a non-cash item. Look for depreciation, impairment, amortization, provision, bad debt in a question. Look for non-cash item, and they are depreciation is their leader, followed by amortization, chairman, impairment, and the subordinates, provisions, and bad debt. Good. Look for this in the question. But most often, all examiners, they use depreciation. Why? Is that the only one? They can form bad debt. Me, I'll form provisions. Straightforward. Provision for warranty, like for Provisio. Provision for bad debt, I'll form it. Nicely like that. So let's go. Depreciation. Why are you reversing depreciation? It's non-cash. Any item which has gone here, which has passed through this figure, which is not non-cash, or it's an alien, take it off. So let's go to the footnote. They told us, getting to the last footnote, I said depreciation charge for the year, including the statement of profit and loss, was 43 million.
That's
So I
right.
must reverse it. Now,
Okay.
depreciation, it has been subtracted from this profit. So I'll come and do what? Add back. So add back 43 million to what they've done here. And from there, it seems like this 43. I want to write small 2. If I write small 2, you will not see. Good. So the position is 43. Then when you're done, any alien, what is a alien? They are the strangers. Any stranger which has entered this,
It's a quick question.
any stranger which has entered this these profits, let's take him. So let's go. First thing, I can see the one on the face. Kindly utilize the sections that you don't need to work on. First, go to the P&L. Check, is there any other income? There's finance income here, 6. So this finance income is a stranger. Where do you record finance income? Finance income is a stranger.
What's
So
the financial activity?
where? Investing activity, right?
Yes.
Yeah.
Okay, so we'll take him there. So it represents interest received. So investing
This
activity,
thing is not stable.
good. So finance income. Finance income is 6. They have added it, so I have to subtract, reverse out.
Okay.
From here, I must calculate profit or loss on disposal. In fact, they told me loss on disposal. The footnote, let's go to the note that say that. Note number 1. It says that during 2014, items of land and equipment, which originally cost 40 million, were disposed of, resulting in a loss of 6 million. So that means this 6 million has been subtracted from the profit because of the loss. And this is alien. It's a stranger. So let's go and add back. So loss on disposal. Loss on disposal. 6. I'm adding. Why? Because they have subtracted. Okay, then we continue the game. Then an item again. Now we need to look out for nope. Okay, so let's quickly go to the financial position and look at the capital surplus and then analyze it before we close the chapter. Capital surplus talks about revaluations, right? Good. So it's just a revaluation. So let's see whether they are comprehensive income. They charge OCI, no OCI. If there are no OCI and there's a capital surplus, decrease in capital surplus. So we can, how do you call it, reverse it in the assets. So over here, since it has not been reflected in the P&L, it's different, 97 and 66, the difference.
31.
We report it, which is 21.
31.
31, we are going to report it in the PP computation. Why? Now, this is a loss. You know, losses are not treated against revaluation loss, is not subtracted from the revaluation reserve on the statement of changes in equity. No, we don't do that. We add it to the operating expenses, losses, revaluation loss and expense, which goes to P&L. So unless there's previous gain, so anytime there's a previous gain, then the revaluation loss should not go towards the P&L. And that is what the examiner wants to test here indirectly. So it means that the difference here, it has been like reversal of previous gain. They had a loss during the year. So this should be accounted for in the acquisition of PPE. That's all. We are done. That'll be the last part two. Then we're done with the operating activities. Then we go to changes in working capital. The space here is too small, so I'll continue from another angle. So continuation. Changes in working capital. So changes in working capital. Let me start from here. Working capital. There are three working capital items: inventory, receivable, and payable. So check whether it has increased or decreased. So let's go to the financial position. Let's first check inventories. So inventory has decreased. So inventory has decreased over the period. Inventory decreases over the period. So which is inflow or outflow?
Inflow.
Inflow.
Okay, so it is inflow because we have disposed of some of the goods. So we have actually received money. So we find the difference. 173 minus 123.
53.
Sorry, 176. So third examiner, decrease in inventory. Open the bracket. 176 minus 123. Answer.
53.
So 53. That one should come under the first currency, not the last one. That one should come under the first currency. That one should come under the first currency. Now let's go to receivable. Receivable. Receivable to trade receivable. It has increased from 87 to 95. So which is what? Receivable. So increase. So that examiner, increase in trade receivable. Into bracket 97 minus 85 or so, right?
95.
95
Yes.
minus 87. And then that will give us,
8.
kindly find the differences and put them down before you come and decide whether it's inflow or outflow. So this is 12.
8.
Okay, so I'll write this one first. Anna B.
It's 8.
8. Good.
Yes, please.
Then I'll go to payable. I'll just find this before I'll decide whether it's inflow or outflow later. The mere fact that I can't decide or I can't determine whether it's inflow or outflow does not mean that I can't do the computation yet. So you go. Trade payable. Okay. Sorry. Trade payable. Okay, they give us a breakdown. Trade payable, the breakdown is from 70 to 126. 70 to 126, that's a note 3. 70 to 126, so I'll find the difference. So that's increase. Here's our third examiner, increase in trade payable. 126 minus 70, answer.
56.
56.
Now, when I do this and I'm done, before I come and think of looking for which one is inflow or outflow, let's start decrease in inventory, inflow or outflow.
Inflow.
Inflow, positive. So here you score it correct. Increase in trade receivable, inflow or outflow.
Outflow.
Flow.
This is outflow. So give brackets. So here you get it wrong. Increase in payable, inflow or outflow.
Outflow.
Increase
Yes.
in trade payable. That is inflow.
It's
That is
inflow.
payable. Inflow because they've given us a lot of goods on credit. We didn't pay them. So they've given us additional goods. They've
Okay.
given us money in the form of goods. We are holding on to the cash that we're supposed to give it to them. If you're holding somebody's cash, then it's an inflow to you. You have received money.
Yeah.
The person gives us goods and we're supposed to exchange with money. We still have the money. So indirectly, the person has given us money. So positive. Adding all these, what do you get? And then all these three. So 53 minus 8
10.
plus
101.
101.
So the answer will be 100 and then 1.
1.
This one gives 10 ticks. So make sure that 10 ticks you score all. The 10 ticks there, 9 here and 1 here, making 10. Now add all, starting from the profit before interest and tax, coming down, you add all. The answer, we call it operating cash flow before interest and tax.
270.
Operating cash flow before interest and tax. So that means we've been able to massage or adjust the profit well to arrive at cash. What a good news. So the answer is
270.
275.
70.
Okay, then interest paid and tax paid. So right here, interest paid, then tax paid. Let's go into the computation. Interest paid and tax paid. These two are the simplest computation we can get. How? Only 3 items. Okay, so I wish let me produce them. Okay, so I can clean the top and do the working there, or I can do the working here. Okay, so let's see. I hope I can change some parts of the board and do the workings there. Or
Yeah.
unless somewhere here and do the workings here. So when I'm done, I'll clean the workings and put it in. So workings. Wow, what a good news. We've worked plenty, no workings. Can you do this under P&L and balance sheet before you finish cost of sales alone? That workings.
Please, the
Before you
network
finish.
is misbehaving again.
Okay, so the network now. Now the anything paid in cash flow, don't worry yourself. If you are looking for, let's say, coffee paid, K paid, K paid, just open balance of K, add movement of K, less closing balance of K. Oh, it's not go here. Less what? Movement of K. That's why it's not coming. In fact, honestly speaking, let me clear this side and do the workings here, so that you can see it clear. So we're saying that anything paid. So anything paid, I started by saying K paid. K paid is equal to open balance of K, so much. Add movement of K, less closing balance of K. This is called K paid. What a good news. This is K paid. So that's all. So if you're looking for interest paid, just in KK and put interest there. Obviously, if you're looking for tax paid, just in the KK and put the tax there, you are done. So if I put interest here, interest here, interest here, interest here, oh, I'll get interest paid. That's all. Now, what's the open balance of interest? So let's fill in the empty space. To add the open balance of interest. So let's go to the footnote or the balance sheet and pick the interest payable. Interest payable, the open balance is 0. But I can't see any open balance here. So meaning that at the beginning of the year, the company were not owing any interest. They only owe interest at the end. Okay, so open balance, dash. So open balance here, dash. Don't forget to report in currency in millions. Add the movement. Over here, it's from the P&L. So we call it interest expense or finance cost. The one in the P&L. If you even touch it, is the one that we add back. Which is 70, right?
17. Yes.
So the one that we add back, 17 from the P&L. Less interest what? The closing balance of the interest. Which is 7.3 or 73.
73.
Okay, so do the computation and see whether it's 73 or 7.3.
I think it should be 7.3 because and because we run in negatives.
So what happened is this particular trace is 7 for 2014 and 3 for 2013. So open balance is 3, closing balance is what? 7. But if I add this, I'm not getting 172 unless there should be 7.
It's true. It's true.
Okay. Open balance is there. So open balance is 3. Then we add it to the interest expense from the P&L. It's the same figure that we added back to the profit before tax to arrive at the profit before interest and tax. Less the closing balance. Now, whatever you get is the paid. So we'll get 13
That's right.
as the interest paid. So interest paid here is automatically 13. So I tell examiner interest paid 13. Then let's go to tax paid. So this working is number 1. First working on the list. So workings W1. tax paid. W2. So tax paid to the same show. Follow the same procedure. Anything paid. Don't worry yourself. So note workings number 1, number 2. Tax paid. Open balance. Tax expense. Less closing balance. Closing balance. Then I'll get my answer. So let's go and pick it from the question. Open balance of the tax is 54. Closing balance is what? 39. So 54, 39. You sure? 54, 39. Then 11 the income tax expense from the P&L, the movement. So P&L, where are you? Income tax expense 47. Income tax expense is 47. When I do this computation, whatever I get is for
62.
tax. 62, right?
Yes.
Okay, so this is 62. At the end of the day, all what I have to do is push them in 62, less 62. Put them in brackets. Now, when you sum them up, what will be your, call it net cash flow from OA, operating activity. So 270 minus 30 minus 62. Answer
195.
195.
195.
Yes.
Okay, so 195. Then you continue. Investing activity. Cash flow from investing activity. Because the space here is also too small, I need to shift to the other end. So kindly jot some few points from the workings, number 1 and 2, before I take them off. So now I'll clean workings 1 and 2, and then replace it. Or continue the main cash flow there. That means I may come and clean this side too. So cash flow from investment activity. So cash flow from IA. First thing, let's check whether there is a disposal and the investment income. Yes, the finance income that will reverse, it must be here. Finance income. Now here we must record it in the first currency. So let me do it in a way that I can get space. Finance income. First currency. The answer was 6. So it must be positive. Now let's go. Is there any disposal of assets?
Yes.
Yes. According to note 1, they sold assets.
Yeah.
The PP during 2014, items of plants and equipment which had originally cost 40 million were disposed of, resulting in a loss of 6 million, a net book value of 28 million. So now arrange this item well and make proceed a subject. So here workings number 3. You are looking for proceeds. Now with the proceeds, just tell the examiner, Mr. Examiner, relax, relax. The proceed will be like this. Looking at this, we start by saying we do the computation of the profit or loss on disposal. Everything. Right here, proceed, the balancing figure. For now, leave it empty. I will put X there. Less carrying amount. See, they say the carrying amount is 28 million. Put it in bracket. At the end of the day, they had a loss. A loss of 6 million. So loss on disposal. So the question is, what should I subtract 28 from so that at the end of the day I'll get negative 6? That means whatever I say should be lower than this by 6. So subtract 6 from this 22. So that means the proceed is what? 22.
34. Okay,
So you come here, proceed. Right here, proceed. In bracket, working number 3. The proceed is 22, positive figure. Then go to workings number 4, almighty. Well, you must get it for us. And here there's something inside that it makes it very interesting. Let's go. That is the acquisition of PPE. So right here, acquisition of PPE. Workings number 4. Acquisition of PPE. So workings number 4. Let's go. So workings number 4. W 4. Acquisition of PPE. Here start by saying open balance of PPE. Balance brought down. Take the open balance of the PPE and adjust the PPE well. The balancing figure or the difference will be the acquisition. So when I go to the PPE from the balance sheet, open balance is 264, closing balance 327. So I'll come and pick it later. So 264. So 264. That's the open balance.
Okay.
Then when you adjust it with all the items that will affect PP. Example, depreciation. Don't forget depreciation. So the depreciation charge, the one you charge to the 40,000, right?
43.
43,000. Depreciation reduce current amount, so kindly subtract. Then any other item that is the sold asset, right? Less the
Yes.
current amount, so right there, disposal. Please, and please again, we need what? The current amount of the disposed asset. 28. Again, subtract. Why is subtracting? Because disposal will reduce what? The asset that we have. Good. Then you check whether there's revaluation gain or loss. But in this question, we have established that there was what? Revaluation loss, not a gain. It was a loss because they've used it to offset what? A previous gain. And that's what you see in the income, sorry, the capital surplus from 97 up to 66. A difference of what? 31.
31.
35.
1.
51.
31. 31, right?
Yes.
Okay.
Okay, so what happened is this. Right here, revaluation loss, and then do the computation. Open a bracket nicely. Do your computation there for us. So all workings clearly. So let me shift the revaluation upwards a little. So 97 minus 66, 31. It's a loss, so subtract. Wow. Once everything going to be a loss. No transfer, no acquisition. Fine. Leave enough space around the closing balance. Leave enough space here. Then analyze it and write the closing balance down. So leave enough space. And then analyze it. The closing balance 327, right?
Yes.
And then call it closing balance. So balance carry down. So that bit is not coming. So balance carry down. Then you find the difference. Add everything. Whatever you get, the difference between that one and this one is the answer.
165.
165.
65.
So name it cash or purchase of PP. So that I write here cash or purchases of PP. So come and put it here. 165 cash or purchase of PP. Cash or purchase of PP. Okay, so we are done. Just a few points down. And my next cleaning place is this, the workings number 4. We'll go. Okay, so taking workings 4 out to continue the game. I think dealt with all the investing activity. So we can sum up.
Please, the acquisition, are we subtracting? Is it a negative?
Yes, it must be in brackets because it's an outflow. Funds are moving out. So it must be in brackets. Good one. So I said 22 minus 165. Answer.
137.
137.
7.
Stepping down and write it here. Then examine the net cash flow from where? From IA, investment activity. Now let's go to the last section, financing activity. So financing activity. That examiner that we are computing cash flow from financing activity. So cash flows from FA, financing activity. First thing, you check whether they've issued shares for cash. Whether
I have a
they've issued
question.
shares. Okay, so we will look at this. Now, cash flow from financing activity. Let's go. Just check the debt and equity and check dividend, whether the dividend paid.
Dividend is in
Good.
notes.
So, share capital, when we check, it has increased from 120 to 230. It has increased by 110. However, they said that they've used or they've converted a portion, 50 million of the debenture into share capital. So not all the increase in share capital represents cash. So make sure that after you find the difference, the 110, subtract the 50 from it. So therefore, issue of shares for cash. Issue of shares for cash. To be into bracket, the 230 minus 120 minus 50. and that one will give us 60, and it's going to be positive. They didn't pay the venture, so the last item left is the dividend paid in a period, which is 32. So dividend paid is 32. So dividend paid 32. So at the end of the day, we'll get something like 28. Call it net cash flow. Net cash flow from financing, FA. Now, when you're done, you add all the three net cash flow, but don't do that. Let's do, let's take insurance. So we're supposed to add 195 minus 135 plus 28. You put the answer here. Calculate, just put X there. And this section, you must get this section for me clearly. Okay, so what you have to do is this. Good. When you add or don't write anything there, call it net cash flow for the year. Net cash flow for the year. Then third examiner, cash and cash equivalent at the start. Cash and cash equivalent. So cash and cash equivalent. So use the term brought down. The same thing here and carry down. Now when I add, let's assume that the brought down is Y. When I add the open balance to that of the cash and cash equivalent, so the cash, net cash flow for the year, I must get the closing balance. Of Z. Okay, so all these figures, you can find them without the help of this. No, you can find them. Because if there's any error somewhere, so that will not affect us. These three figures, we must score them correctly, whether you finish it or not. How? Okay, so I'll clean this side and do those computations here. I'll do the computation here. So let me carry this figure here and come and put it somewhere. Let me put it just here so that when we are adding, we will remember. So I'm putting this, it's positive figure, not negative. So I'm going to clean this side and do the computation here, the cash and cash equivalent, the composition. Please and please again, this is how you must compute your cash and cash equivalent. You can do it on a face, but workings number 4 or 5.
5.
Workings number 5. Cash and cash equivalent. Put beginning here, go down, and put the closing balance here, or you can change it, any of them. You can also make closing balance here, open balance here, whichever one you do. It's made up of 3 items. Number 1, it's made up of your cash and bank balance. So check cash or bank balance plus, so your cash balance plus any liquid investment or short-term investment. This short-term investment, the examiner should tell you that, oh, it is highly liquid, or it can be classified under what? Cash equivalent, before you do that. Less overdraft, if any, bank overdraft. Less bank overdraft. Whatever answer you get, that is a cash and cash equivalent. So let's fill the empty space. let's go to the notes. They said cash at bank and in hand 29 and dash. So closing balance is what?
Dash.
29. Open balance is dash. So 29 and here is dash. Again, don't forget to reporting currency. Then the short-term investment. Let's go to short-term investments. Short-term investments is also 65. Closing balance is 65. Open balance is what? 30. So 30, 65. Then with only overdraft, then we are free to go. Overdraft was classified as part of the current liabilities. So let's go. Bank overdraft. Open balance is 22. Closing balance dash. So 22, we subtract. At the end of the day, let's see. Adding all this, you get 8. Adding all this, 29 plus 65.
94.
So 94. Okay, so that means the cash and cash equivalent at the end is 94. So this Z here is 94. The one at the start, at the beginning, is 8. So the question is, what should be here? So that when I add to this X, I will get 94. So there's a figure here. When I add 8 to it, I'll get 94. What's that figure?
86.
So this one is 6. That will be 86, right? Good. So it means that when you add all the 3 net cash flows, you must get 86. Start adding them. If you add, you not get 86, please don't change your answer. So 195 minus 137. That's this one is the operating activities, net cash flow from operating activities, plus investing, plus this should give us 86. In event where
Yeah, you get it.
yes, event where there are errors or issues, don't change this answer. This one we call it a comprehensive insurance. If there's any errors where these figures, some of them were wrong or calculator gave you wrong figure, this one you are free to go. That is all. Sometimes it will ask you to analyze a cash flow statement. Whereas I'm not asking you to analyze cash flow statement, you check the cash flow from operating activity should be positive always. That means the company is doing well. Internally, if it is positive, meaning that the company can generate funds internally, the operating activity, there's always positive cash flow, meaning that when they leave you alone, you don't need external support. You don't need too much of external support. Internally, you can generate whatever you need. But where you have a negative cash flow coming from your operating activity, it calls for what? A great concern, because internally, you can't manage your staff. So always you need external support. And there's a cost to that. Cost of financing, borrowing cost. Now, the investing, it must be negative, as you see here. When it's negative, it's a sign that the company is investing. Now, we like companies that are investing today so that tomorrow they reap their investment. But if it's positive, meaning that you are selling your investment, why are you selling all your investments? That is why they bought asset of 167. They've invested of 167, but they sold what? Only 22. So looking at the comparison, they've really done well. So investing should always be negative if the company is doing well. But financing is neutral. Financing is neutral. It can be positive or negative, depending on whether they are repaying their debt, issuing of shares, and those stuff. That is all. So on that note, we are done. If you have a question, kindly ask. If you have no question, we'll close the chapter of the game. Kindly request for the lecture material. If you don't have it, and kindly subscribe if you have not done that. Good.